Over the last several years, one of the most important companies driving both the S&P 500 and our growth stock strategies has been Nvidia. For many of you, Nvidia is likely the largest position in your portfolio, either directly through our growth stock strategies or indirectly through the S&P 500 index exposure. On Wednesday, Nvidia reported Q1 earnings, and frankly, there was nothing disappointing about the report. The company exceeded expectations across the board. They beat earnings estimates, revenue expectations, and guidance projections. What continues to stand out for us is not just how strong the current numbers are, but how dramatically analysts have underestimated the company's growth trajectory. To put that in perspective, just 1 year ago, Wall Street analysts expected Nvidia to earn about $1.36 per share in Q1 of this year. Instead, the company delivered $1.87 per share. This is an extraordinary level of earnings growth for a company this size. In addition to the strong operating results, management announced an additional $80 billion stock buyback and increased the dividend from a penny to 25 cents a share. Companies do not authorize buybacks of that magnitude unless they have tremendous confidence in the durability of future cash flows and earnings power. Importantly, we continue to believe Nvidia's competitive advantages extend far beyond simply manufacturing chips. Nvidia has built an entire ecosystem around AI infrastructure. So in addition to GPUs, they now provide networking solutions, inference systems, software platforms, and development tools customers have deeply integrated into their businesses. Their CUDA software ecosystem and networking architecture create extremely high switching costs for customers and provide Nvidia with a significant competitive advantage over peers attempting to enter the space. One of the concerns we frequently hear is whether spending on artificial intelligence can continue at this pace. We think it can. AI investment is not simply a short-term trend or a bubble. If AI models continue to evolve and improve, businesses will continue to spend. Companies simply cannot afford to fall behind competitors that are using AI to improve productivity, automate workflows, reduce costs, and expand margins. Importantly, businesses can afford to make these investments. Corporate profit margins remain historically strong, giving companies the financial flexibility to continue to invest aggressively in AI infrastructure. What is probably the most compelling is that we're still in the early innings of adoption. During Q1 earnings season, about 50% of companies stated that they've adopted AI in some form. While that number is meaningful, it implies there's still substantial runway ahead as adoption broadens across industries and business models. We continue to believe AI represents one of the most transformational technology cycles we've seen in decades. Similar in many ways to the internet, cloud computing, or mobile adoption. While volatility will occur along the way, we remain constructive on Nvidia's long-term positioning and believe the company continues to be exceptionally well positioned within the AI ecosystem.